Hi, everyone. I'm Devon Coombs, and today I'm going to be talking about what I think will be the next housing market crash. So, I'm going to give a CPA perspective on the housing market currently, and specifically, I'm going to be looking at the California housing market. I think this is really interesting. It's something that I've been thinking about a lot. Will the housing market crash? There's so much demand, and housing prices are astronomical right now. So, for example, where I live in a cheaper part of San Jose, single family homes are going upward from 1.3 million to $2 million for a standard 1,200 square foot home, 3 bedrooms, 2 bath. So is that a reasonable price? Will prices only go up? Seems like a lot of controversy. So let's do an analysis with the tools that I talk about on our program. So my preliminary conclusion on all this is that there's speculation and overvaluation in the current market. That overvaluation is really driven from speculation from buyers, so that the prices will continue to go up. So we're going to look at today how rental markets and the purchase markets are not in equilibrium. And it's really in strong favor of renters for one of the first times I've ever seen. And I've been looking at the housing market quite a bit over the last 10 years while I try to analyze if I should buy a home or not. Homeowners are really relying on appreciation of the home values to justify the current valuation. So that means that if a home buyer is buying a $1.5 million home, that's really because they expect the price to continue to go up. And as we've seen with other assets in the past, just because prices go up, have gone up quite a bit, we know that that doesn't necessarily mean it'll hold true over the short term. Apps like Redfin and Zillow are increasing this fear of FOMO, like the fear of missing out, and driving extremely speculative behavior, where I've even caught myself on this, where I'll check Redfin probably every other day and see how expensive homes are. And I get nervous. I honestly get nervous that, well, what if I can't buy a single family home because I'll continue to get priced out. If prices keep going up 20%, that's hundreds of thousands of dollars a year. Income can't make up for that. So this FOMO behavior, though, doesn't change the fact that homes just won't be affordable. So the Fed is actively trying to reduce inflation because we can't live in an environment, most people can't live in an environment where prices are rising that quickly, especially for our major purchases in life, like houses and cars. And what we learned with the last pandemic was we don't want to bet against the Fed, right? The Fed decreased interest rates and eased borrowing. And what did we see? We saw that inflation picked up drastically. And so anyone who was wise when they first saw those interest rates drop bought long-term assets, and they're seeing the gains now. Now the Fed is making a correction, and we would expect that the Fed's correction ultimately to drive down these prices. But these are just a general economic viewpoint from a CPA. But I think that would be most useful is to look at valuation models. So as a CPA, most of the time we look at net present value of future cash flows at a discount rate. They're called NPV models, in order to determine if a business decision is justified. And I would say that a personal decision would be fair under the same valuation frameworks. And so we're going to look at these, and I'm going to talk through them a bit. But let's look at the standard California home right now in a cheaper neighborhood in San Jose. We're talking about a 3 bedroom, 2 bath house, pretty small, average size, 1, 2, 3, 4 square feet. And it costs about $1.3 million. And that's the list price. Most houses are going above list now. With 20% down, that's $260,000 you have to have cash available now that you otherwise could be investing into the market, where you can invest in the stock market, put it in a savings or bonds, even though interests are low, they're going up. So with 20% down, you still have a monthly mortgage about $6,000 at a 5% rate. As the interest rates go up, it's only going to increase. And with such a large loan, right, you're borrowing $1 million, that interest rate sensitivity is going to drastically increase the monthly mortgage payments. And then you also have insurance and taxes of about $1,500 a month. And there's limitations on how you can take those as tax benefits nowadays. So I'm not going to discuss that here. Similar properties now are renting for about $3,500 to $4,000 a month. $4,000 is really high end. You probably are getting a much newer, much larger plot of land, but you can get properties for as low as $3,500 a month. And so what we're talking about is if you fully paid off the house, so if you had no mortgage, you'd only be making about $1,500 to $2,000 a month off of your property that cost you $1.3 million. And that's if you paid all cash and didn't have interest charges with it. So you could see we're going to use all of these inputs to determine, like, well, is the $1.3 million cost justified? And so first we could look at the net present value of a perpetuity. So let's say we wanted to make that $1,500 a month for the rest of our lives. If we took a 4% return rate, which is very low, if we put it in a mixed stock and bond market, you could almost guarantee to get a 4% return rate over the long term. You would only need to invest about $450,000, right? So to make that $1,500 return, if we were to buy a property for all cash and then rent it out, you'd only have to put $450,000. So you can see there's a huge difference, right? It's almost 1/3 of the cost to get your return on investment. And that's because people are believing in the appreciation of their property. So if we take away that assumption, we start being in significant trouble, right? The net present value of a property is another way we can look at it. So what if we were to sell the property in 30 years? So if we're really to hold the property over a long term, but because we know interest rates are going up, we tighten the depreciation. So like, let's say instead of 10% appreciation, we bring it down to 2%. Let's say it stays a lot flatter. That still means your $1.3 million property is closer to $3 million at the end of 30 years. But we actually wind up still in quite a negative zone where it'd actually be worth negative $1 million today. So we'd actually lose out on $1 million today if we bought the property instead of investing it in the market at a 6% return rate. We could also use rent versus buy theory. So if we take the difference of prices between if we were to rent with a large cost appreciation on the rent, like 4%, versus if we were to buy and just live in the house indefinitely, it turns out we're in a very unique situation where renting would always be better. We'd wind up, if you're able to invest your money today at a low return rate of 4 to 6%, you would never make more money than if you bought, unless appreciation of the house winds up being larger than the market, which seems unreasonable at record high prices. Lastly, rent mitigation. So to break even on rent, we can look at, well, what would it cost today? Like if we were to pay the $3,500 to $4,000 a month at a 2% return rate, a 4% to 6% appreciation rate, what would that look like as a net present value over 30 years? And we're looking at about $500,000 to $700,000. So that means that to buy a house, if we wanted to buy instead of renting to find a justifiable price, you'd really have to be spending upwards of $700,000. Maybe you could justify $800,000 if you up the appreciation a little bit. But you can see that's about half, a little less than half of what the current costs are. So what are my conclusions here? Like based on all these valuation models, it really looks like we're at the top of the market. So I have a small townhome in San Jose. If I had more flexibility and didn't have a young daughter, I would probably sell my property right now and look to rent to take advantage of the interest rate arbitrage. Like I would expect that rental markets will go up over time and the housing market will go down probably within the next few years. I'd expect by next year. And so and then you could take advantage of rent for a year and then probably buy into the market when it's lower and take your gain now. You'll probably see a frenzy this summer, I'm guessing, but it might cool off even this summer. You might see a frenzy of FOMO, people trying to buy homes before interest rates get too high, but then by next year, it should really settle down. Despite supply constraints, these valuation models really prove that we are in really negative territory. So with interest rates increasing, everyone does not realize how much that impacts, especially expensive homes. So I believe that this will really drastically impact demand. People will just no longer look at houses and start going into the rental market. That'll over the long term raise rent, and that over the long term also decrease the housing prices. It's also important to note that historically a 1% increase in a 30-year mortgage rate normally results in a 10% decrease in prices. In the last month or two, we've seen over 2% increase in 30-year mortgage rates. That means that we should see a 20% decrease in prices. That seems reasonable. And if interest rates keep going up, we should expect to see more. So the house valuation models say that prices decrease between 20 to 50% in California seems pretty reasonable. And so I'd wait till that decline. So that $1.3 million home, right, we're saying that should probably get closer to $1 million within the next year or two. We'll see how long that takes. I've never lived through something like this, but that's my expectation. Also, ultimately, we should expect that renting is going to return to a place where it is more expensive than buying in the long run. Like at the end of the day, it doesn't make sense logically why people are buying homes other than for the American dream. Like there's the emotional aspect, the FOMO aspect, but it doesn't make logical sense why we're buying homes at a premium to renting. And so you'd expect that to reach equilibrium over time. So my expectation, as I said, is that the market is going to go down. I don't think it's going to be a huge crash, but I do think you're going to see prices significantly decrease in the not too far future. So this is how I would approach problem solving if I was in the real estate market as an individual or as a business. Please take in mind this is just my opinion. This is just, I could be completely wrong. I could be missing things. The Fed could drop their interest rate hikes, or there's going to be other shocks to the market. But based on the current situation, this is where I think we're heading. Let me know what you think. I'm curious on your suggestions, curious if you think how far off I am. I know it's controversial, so it'd be fun to talk about. Okay. Thank you very much for watching, and hope you have a good one. Bye-bye.